American markets, including the Canadian benchmark S&P TSX Composite Index, have traded down since over the past week, leading investors to wonder, was the rally in January another bear market head fake? Joining us to talk about it is Rob Tetro, Senior Investment Advisor and Portfolio Manager at Tetrault Wealth Advisory Group, Canaccord Genuity, and he joins us from Winnipeg. Rob, thanks a lot for joining us. What is your take on these markets?
Well, yes, thanks for having me, Paul. Great to be here with you. Freezing Winnipeg day. I know you guys have storms out there too, but this is like minus 40 today out here. These markets. So yes, when we emailed each other, I want to say on Feb 1 or Feb 2 to kind of book this morning, I had sent you a note. I said, I'm predicting that the markets will be down 6% by then. And you kind of laughed and said, oh yeah, maybe, I don't know if what the market will do in February. Well, I was pretty darn close. We were down about 4 or 5% since that email. Now, I don't think that this is a head fake. I actually do think that this bullish market is actually here to stay for a lot of reasons and kind of the same sentiment that I've had in the past. Most notably, historically, these bear markets, they're not expected to last 2-3 years. I don't think there's enough kind of ingredients in the bear market soup to create a significant bear market for a long term. I do think we're poised to have a recovery, the third year of the election cycle, earnings, the commentary that's coming around earnings, inflation that's coming down. I do think that we can't avoid this volatility short term. You can't have a January like we saw without a little bit of volatility. So I did expect some volatility. But here's the problem, Paul. You can't just not be long, right? You can't just go to cash and wait for a potential head fake and then say, I'm going to get back in. You just can't manage money that way, right?
What's your take on the rally that we've seen in tech stocks? The big losers in 2022 got off to a pretty hot start this year.
Well, I think they have to be the leaders in this recovery. I think there's no other way. And everything we're seeing, even NVIDIA reported earnings today, and I think it was pretty good. It was gangbusters. I expect that stock to be up big today. But I think tech. So there was a lot of short covering last week. We saw 99.5 percentile. I think it was the second largest short covering day in kind of the last 20 years or something like that. Short covering was big for the tech sector. And that tells me that, call it the smart money or the long money or the hedge money, whatever you want to call it, they're kind of done with that position, right? If you're covering your shorts, obviously you're bullish or you're done being bearish on that sector. So to me, that's another positive sign that, although they're often wrong, but it's another positive sign that I think that sector should lead the recovery here in 2023. I'm a big believer in that.
I'd like to throw a company-specific story at you. It's a big one. We mentioned it in our newscast. First Quantum Minerals, one of the biggest and most high-profile mining companies and stocks in this country. The problems with Panama aren't getting any better, and they've reached the point now, this is a tax dispute, of course, they've reached the point now where Panama says it's unable to produce copper at its very large mine, the El Cobre mine in Panama. What's your take on this, Robin? And what are the lessons for investors?
We have such short memories, Paul? As investors, Canadian retail investors have such short memories. They jump into these stocks. Huge geopolitical risk. We forget about the very real possibility that, we call this a tax disagreement or call it whatever you want, but it's effectively the local government seizing assets, taking ownership. I don't know this story specifically, just what I've read, but I mean, it's problematic. It's happened before. It will happen again. And this is something that unless you're being compensated for that very specific and significant risk, you need to be getting a significant discount to comparables that are trading in Canada and the US, because this doesn't happen in Canada, right? Like you never have to worry about one of your local Canadian miners being, seized by the government, having a tax problem, or not letting you produce copper. That just doesn't happen. So if you're doing this, we avoid these pretty much all the time, just because you're not being compensated for that risk. So you're taking on a whole bunch of undue risk. You forget about it, but the risk of the actual event happening is a disaster on your stock portfolio. So if you're getting into these companies, you need to be buying it at like significant discounts, 5, 6 multiples, not 10, 15, 20 multiples. And that's not the case with this company. So I feel bad for investors, but it's going to happen again.
So what would you say, Rob, to a client who says, Rob, I want to buy these shares. This problem with Panama is going to get sorted out eventually, and these shares are going to rise in a high copper price environment?
Well, we operate on a discretionary basis. So we're fiduciaries and we manage portfolios on a discretionary basis. So largely, I tell that client we're probably not doing that. I mean, we could have a discussion about it. But the reality of it is, again, we think that maybe that'll happen, but you want to go to Vegas and you want to gamble on black, do that. But I would suggest not doing that with your portfolio here. You're right, Paul. A lot of these times this is noise, and noise makes news, and noise hammers stocks. But what if it doesn't? What if this thing doesn't come back? Are you going to really own this dog in your portfolio forever?
What can you tell us about what your client portfolios look like right now in terms of their equity market exposure, and perhaps what sectors of the equity market you're most exposed to?
Okay, so for us, I've preached this before on this show, and those who follow me on social media, they know this. I'm a believer in alternative assets, so real assets, not kind of risky alts, like not long short hedges or not, but we believe in owning real alternative assets in your portfolio because they're uncorrelated to the stock market, because they provide tax efficient returns for our corporate accounts and for our non-registered accounts, and because our high net worth clients, they want that, right? The wealthiest individuals on the planet, they own 40, 50, 60% of their portfolio in non-stock market exposed companies. So we do the same thing. We don't go 50 to 60%, but anywhere from 20 to 40% of alternatives. We work with third parties, private, either LPs or pension funds or whatever. And we have direct exposure to that in our clients' portfolios through a whole bunch of these products that Canaccord, my firm, allows us. They do the due diligence on them. They own it. So that's anywhere from 20 to 40%. Equities, almost 0% traditional fixed income. We've been almost zero for a very long time, for I'd say 2 years. We do have a small portion of either private debt or short-term fixed income, and that could potentially increase. We might increase our fixed income exposure here because bonds might be attractive in the near future. We're looking at that closely. But let's say if we have 30, 40% alts, the rest is 50, 60, 70% maybe. That's a small portion of either cash or traditional fixed or non-traditional fixed income, 10, 20%, and the rest is equity. So about half our portfolio in equities these days.